Hello, everyone. Welcome back. Today feels different, not because the headlines are louder than usual, but because beneath the noise, something far more important is quietly shifting. Prices feel heavier, savings feel weaker, and even when the charts look calm, there's an uneasiness you can't quite shake. If you've been wondering why the world's biggest currencies appear stable on the surface, yet feel fragile underneath, you're not imagining it. We are moving deeper into a cycle that rarely ends gently. These cycles don't collapse overnight. They don't announce themselves with sirens. They unravel slowly, through rising debt, temporary fixes, postponed decisions, and the comforting illusion that we'll deal with it later. Until later arrives. Here's the uncomfortable truth. Currency cycles don't end because policymakers suddenly become wise. They end because reality forces a repricing. Sometimes that repricing is slow, years of declining purchasing power. Sometimes it's fast, a sharp devaluation. And sometimes it's messy, political chaos, policy reversals, and a public that quietly decides, I don't trust this anymore. Why markets feel so nervous right now. Markets used to run on a fairly predictable engine. Liquidity in, prices rise. Liquidity out, prices wobble. But that rhythm has been interrupted, not because liquidity disappeared, but because politics and geopolitics stepped in front of the engine. One day it's tariffs, next day it's threats to central bank independence, then energy shocks, then something no one had on their radar a year ago. This is a headline-driven market, and in this environment, confidence becomes its own asset class. The real danger isn't bad news, it's speed. The speed at which one headline flips sentiment, the speed at which sentiment moves capital. So ask yourself this. What happens when a confidence-based financial system collides with a world addicted to debt? Fiscal dominance, the quiet force. Behind the curtain. This brings us to a concept that sounds academic, but isn't. Fiscal dominance. When governments run persistent deficits, central banks stop being referees and start becoming plumbers. They don't enforce discipline. They keep the system from flooding. They can talk tough. They can promise restraint. But when something breaks, they show up with liquidity. That's why extreme market behavior isn't random. It's pressure being released from a system that's stretched too tight. How currencies actually lose value. Big currencies don't fail because of one bad speech. They weaken when debt grows faster than real productivity, promises outpace capacity. The public prefers anything else over holding diluted paper. And here's the part most people miss. A currency can remain dominant and still lose purchasing power. Being widely used is not the same thing as being strong. Think of currency like a measuring tape for your life: rent, food, fuel, healthcare. Now imagine the tape itself slowly shrinking while the numbers stay the same. Your salary rises, your account balance grows, yet the life those numbers buy quietly shrinks. That's devaluation in the real world. The network effect, advantage and trap. Major currencies benefit from massive networks, trade, contracts, pricing systems. That network keeps them in use longer than they deserve. But it also tempts policymakers to push harder because punishment is delayed. The bill doesn't disappear. It just arrives later. Networks don't prevent devaluation. They stretch the timeline and spread the cost. How repricing actually happens. Currency repricing isn't a decree. It's a vote. Millions of investors, institutions, and households vote with what they hold, what they demand, and what protection they require. When confidence is high, people accept low yields, long maturities, minimal protection. When confidence falls, yields rise, maturities shorten, hedging demand explodes. Nothing official has to change, yet the system tightens. That's why interest rates can rise for two very different reasons: strength and trust, or fear and compensation. Charts look the same. Reality does not. Why this era? Feels like a trap. Rates too low punish savers. Rates too high break the system. Either way, the currency pays. That's why comfortable outcomes are narrowing. And here's the deeper issue. Governments aren't just borrowing money, they're borrowing future purchasing power. When repayment becomes political, it usually means repayment in weaker units. That's the logic of devaluation. Not malice, not conspiracy. Incentives. Currency is social, not just financial. A currency is a shared belief system. When belief weakens, people hoard. Speculate, distrust institutions, polarize. The cost of living crisis doesn't just hurt wallets, it erodes trust. Asset owners live one reality. Wage earners live another. That gap eventually becomes political fuel. And this is where legitimacy, not inflation, becomes the real battleground. Signals to watch, not predictions. No one rings a bell at the top, but pressure leaves fingerprints. Watch for difficulty issuing long-term debt, rising demand for hedges, energy market instability, asset prices diverging from public mood, policymakers prioritizing market functioning over discipline. One signal is noise, several together is a warning. Strategy, how to survive and stay opportunistic. The goal isn't panic, the goal is positioning. In stable times, laziness is survival. In unstable times, laziness is expensive. Preparation feels boring, because boredom is the price of safety. A resilient framework, resilience, emergency reserves, manageable debt productivity, skills, businesses, cash flow assets, scarcity, assets that resist dilution, optionality, flexibility to act when fear creates opportunity. Build a ship, not a race car. The likely endgame. Most major currency cycles end the same way. Persistent deficits, gradual money creation, negative real rates, quiet erosion of purchasing power, not one announcement, a process. This decade looks like the chapter where pressure builds, trust thins, and volatility becomes permanent. But for the prepared, volatility isn't danger, it's opportunity. Final takeaway. Major currencies aren't collapsing tomorrow, but they are being repriced over time. If you're diversified, disciplined, and flexible, you don't need perfect predictions. You just need to avoid fragility. Because in this era, the most dangerous position is certainty. I'll see you in the next video.